There's a market most people never think about, a market so large it dwarfs the stock exchanges you see on TV, a market that quietly funds governments, anchors pensions, and holds the entire global financial system in place like invisible scaffolding. And right now, that market is doing something it's not supposed to do. It's called the Treasury bond market. And when I say it's big, I mean incomprehensibly big. We're talking about more than $27 trillion in US government debt alone. That's not counting the United Kingdom, Japan, Germany, or any other major economy. This market is supposed to be boring, predictable, safe, the place where retirement funds park money and sleep soundly. But lately, it's been moving like it's trying to tell us something. And the people who understand what it's saying are quietly repositioning themselves for a scenario most investors refuse to believe is possible. Because if this market breaks, it doesn't just hurt bondholders. It rewrites the rules for everything else. Stocks, real estate, currencies, and yes, the metals that have been climbing while most people weren't paying attention. So today we're going to walk through what's actually happening in the bond market, why it matters more than any headline you've seen this month, and what happens to gold and silver if the unthinkable becomes unavoidable. No hype, no predictions pulled from thin air, just the mechanics, the math, and the uncomfortable possibilities nobody wants to discuss out loud. Let's start with something most people get backwards. When you hear the phrase government bonds, your brain probably does one of two things. It either shuts off because it sounds boring, or it pictures something vaguely related to retirement accounts and old people. Both reactions are understandable, and both are dangerous. Because government bonds are not just an investment vehicle. They are the foundation of the modern financial system. They are the collateral banks use to borrow money. They are the assets central banks buy and sell to control interest rates. They are the benchmark against which every other investment is priced. When a pension fund calculates how much it needs to pay retirees, it starts with bond yields. When a bank decides what interest rate to charge you on a mortgage, it starts with bond yields. When a corporation issues debt to expand, the pricing is built on top of bond yields. So when bond yields move, everything else has to adjust. Now here's where it gets interesting. Bond prices and bond yields move in opposite directions. If you buy a bond for $100 that pays $5 a year, your yield is 5%. But if that bond's price drops to $80, the new buyer still gets that same $5 payment, which means their yield just jumped to over 6%. This is not a technicality. This is the hinge the entire system swings on. And right now, long-term government bond yields are elevated and acting strange. The 30-year U.S. Treasury yield has been hovering in the upper 4% range. In the United Kingdom, long-dated government bonds have pushed into the low 5% area. In Japan, officials are publicly concerned about rapid moves in their bond market, a market they've controlled with an iron grip for decades. Why does this matter? Because higher yields mean governments have to pay more to borrow money. And when you're already running massive deficits, higher borrowing costs don't just sting, they compound. Let me give you a number that should make you pause. In fiscal year 2025, the U.S. government spent over $1 trillion just on interest payments. Not on defense, not on healthcare, not on infrastructure. Just interest, the cost of servicing the debt. That's more than the entire defense budget in most years, and it's growing. Now think about what happens when a government finds itself in this position. It has two basic options. It can cut spending dramatically, which is politically radioactive and economically painful, or it can find a way to lower the cost of borrowing. And the fastest way to lower borrowing costs is to push interest rates down. But you can't just wish rates lower. You have to do something. And that something usually involves the central bank stepping in and creating money to buy bonds. This is where the story stops being about numbers on a screen and starts being about the architecture of value itself. Let's talk about what happens when a bond market gets nervous. It doesn't announce itself with sirens. It doesn't send you a notification. It shows up in the trading data. Yields spike a little faster than they should. Auctions, where governments sell new bonds, start to look shaky. Volatility increases. And quietly, behind closed doors, policymakers start using words like orderly market function and ensuring liquidity. Those phrases sound boring. They're not. They're code for we're worried. Because a bond market under stress is not like a stock market crash. Stock markets can collapse and the world keeps turning. Portfolios get hurt, but the lights stay on. Bond markets are different. Bond markets are the foundation. If confidence in government debt breaks, the entire tower wobbles. And here's the nightmare scenario that keeps financial historians awake at night. A true loss of confidence in government bonds doesn't look like a normal crash. It looks like a credibility event. What does that mean in practice? It means investors start to believe that the government will not or cannot make good on its promises without destroying the value of the currency in the process. Not because the government will technically default. The U.S., for example, can always print dollars to pay its debts. But printing money to pay debts is not the same as honoring debts. It's diluting them. And once that dynamic becomes obvious, once people start to believe that their bonds will be paid back in money that's worth less than when they lent it, the psychology shifts. This is not some abstract theory. We've seen versions of this play out in other countries. The United Kingdom had a mini version in 2022 when bond yields spiked so fast, the Bank of England had to intervene to prevent pension funds from collapsing. Japan has been fighting this battle for years, trying to keep yields pinned down while their debt to GDP ratio climbs past 260%. The United States has always been different because the dollar is the global reserve currency. But that's not a permanent shield. It's a privilege, and privileges can be lost. Now, let's bring this back to something concrete. When central banks intervene to calm a bond market, they do it by buying bonds, and they buy bonds with newly created money. This is often called quantitative easing, though the name changes depending on the political climate. The immediate effect is to push bond prices up and yields down, which stabilizes the market. The delayed effect is to increase the money supply, which over time can erode the purchasing power of the currency. And this is where metals enter the story. Gold and silver are not investments in the traditional sense. They don't produce cash flow. They don't pay dividends. They don't have earnings reports. What they do is sit there, finite and tangible, while paper promises multiply. So when a central bank prints money to stabilize a bond market, it sends a signal. The signal is this: we will protect the bond market by diluting the currency. And when that signal gets loud enough, people start moving into assets that can't be printed. This is not speculation. This is pattern recognition. In 2008, when central banks flooded the system with liquidity, gold climbed from around $800 an ounce to over $1,900 by 2011. In 2020, when the pandemic triggered another massive round of money creation, gold hit new all-time highs. And silver, being smaller and more volatile, moved even more dramatically. Now, fast forward to today, gold is flirting with $5,000 an ounce. Silver is approaching $100. And the bond market is showing signs of stress that look eerily familiar to people who study these cycles. The question is not whether metals can go higher. The question is, what happens if the bond market stress escalates into something bigger? Let's talk about silver specifically, because silver has a strange personality. It's part industrial metal, part monetary metal. It's used in solar panels, electronics, medical devices, and 1,000 other applications. But it's also small enough and historical enough that when investors get nervous, it behaves like gold's volatile younger sibling. Right now, the gold to silver ratio is sitting around 50 to 1. That means 1 ounce of gold buys you about 50 ounces of silver. Historically, that ratio has been all over the map. It's been as low as 15 to 1 in ancient times, and as high as 120 to 1 during moments of extreme stress. But here's what matters. When that ratio compresses, when silver starts gaining ground against gold, it's usually a sign that risk appetite is shifting. It means people are not just buying safety, they're buying upside. And silver has upside potential that gold doesn't, purely because of the size difference. The entire above-ground silver market is a fraction of the gold market. When money flows in, it moves the price faster. Now let's layer in the supply side. Silver is unusual because most of it doesn't come from dedicated silver mines. It comes as a byproduct of mining other metals like copper, lead, and zinc. That means when silver prices rise, you can't just flip a switch and mine more silver. You have to mine more of those other metals too. This creates a lag, a slow response time. And in a market where demand is accelerating, slow response time means tightness, and demand has been accelerating. In 2024, global silver demand hit around 1.16 billion ounces. Industrial demand, driven by electronics and solar energy, hit another record. The solar sector alone consumed roughly 200 million ounces, about a fifth of total demand. Now, some people will tell you that solar manufacturers are working to reduce the amount of silver they use per panel, and they are. But here's the twist. Even if they cut silver use per panel by 20%, if they're installing 50% more panels, total consumption still rises. It's not about how much silver goes into each unit, it's about how many units get built. And then there's the deficit. The silver market has been running a structural deficit in recent years, meaning demand has been outpacing supply. Estimates for 2025 suggest a deficit in the neighborhood of 100 million ounces. That might not sound like a lot in a market that produces over 1 billion ounces a year, but deficits compound. Inventories get drawn down, and the inventories that matter most, the ones available for immediate delivery, are not infinite. This is where things get interesting, because the silver market, like the gold market, operates on 2 levels. There's the physical market, where real metal changes hands, and there's the paper market, where contracts are traded that represent silver but may not be backed by actual metal in a vault. Most of the time, this works fine. The paper market provides liquidity and price discovery. But in moments of stress, when people start asking for physical delivery, the system can get tight. We've seen this before. In 2020, during the early pandemic panic, there were reports of silver premiums spiking. meaning people were paying far more than the spot price just to get their hands on physical metal. Mints couldn't keep up. Dealers ran out of stock. And that was just a taste. If we hit a true credibility crisis in the bond market, if central banks respond with aggressive money creation, the demand for physical precious metals could overwhelm the system in a way we haven't seen in modern times. So let's walk through what a real crisis might look like, step by step. Not as a prediction, but as a scenario based on how these systems have behaved historically. Step 1, bond market stress escalates. Maybe it's a failed auction. Maybe it's a spike in yields that triggers margin calls. Maybe it's a geopolitical shock that makes investors question the stability of government finances. The trigger doesn't matter as much as the response. Step 2, central banks intervene. They announce measures to support market function. They start buying bonds. They cut interest rates or signal that cuts are coming. They use language designed to calm markets. Step 3, the intervention works temporarily. Yields stabilize, stock markets bounce, commentators declare the crisis over. But the money that was created to buy those bonds doesn't disappear. It flows into the financial system. Step 4, inflation expectations shift. People start to notice that prices are rising faster than expected. Not just commodity prices, but the cost of living, energy, food, rent, the things people actually buy. Step 5, metals start moving. Gold leads, because gold is what central banks hold and what large institutions use as a hedge. But silver follows. And because silver is smaller and more volatile, it moves faster. Step 6, the feedback loop kicks in. Rising metal prices attract attention. Attention attracts capital. Capital pushes prices higher. Media coverage increases. Retail investors who ignored metals for years suddenly start buying. Step 7, the squeeze. Physical demand overwhelms available supply. Premiums spike. Delivery delays stretch out. The paper market, where most trading happens, starts to decouple from the physical market. People who thought they owned silver through contracts start to realize those contracts might not convert to real metal when they need it. Step 8, the parabolic phase. This is where prices do things that feel unreal, where silver moves 10% in a day, where the charts look like they're broken, where people who mocked metal 6 months ago are suddenly trying to buy in at any price. And then step 9, the one nobody talks about, the aftermath. Because these moves don't last forever. At some point, policy responses change, or the speculative fever breaks, or the system adapts. And when that happens, prices can reverse violently. This is the part that destroys portfolios. Because most people get in late and get out wrong. They buy near the top, panic during the first pullback, and sell at the worst possible moment. So if you're thinking about metals as an investment, the question is not whether they can go higher. The question is whether you have the temperament to hold through the chaos. Now let's talk about the other side, the bear case. The reasons this might not happen or might happen differently than expected. First, governments might actually get their fiscal houses in order. It's unlikely, but it's possible. If spending gets cut, if deficits shrink, if bond markets stabilize without massive intervention, then the pressure valve doesn't blow. Metals could consolidate, go sideways, or even pull back. Second, technology could change the equation. If solar manufacturers dramatically reduce silver usage per panel faster than installations grow, industrial demand could soften. If new mining techniques unlock supply, the deficit could shrink. Third, alternative assets could absorb the fear capital. Over the last decade, a lot of people who would have bought gold bought digital assets instead. If that trend continues, some of the money that historically flowed into metals might go elsewhere. Fourth, central banks could thread the needle. They could manage to support bond markets without triggering runaway inflation. It's a tight balancing act, but it's not impossible. And fifth, the public might just not care. If most people stay focused on stocks, real estate, and whatever the latest trend is, metals could rally without the retail frenzy that pushes them into a true mania. These are all real possibilities, and they're worth respecting. Because markets are not deterministic machines. They're the sum of millions of decisions made by people with different goals, different information, and different levels of fear. But here's what history suggests. When credibility cracks, when the belief that governments can manage their debts without debasing their currencies starts to fade, people reach for tangible assets. Not because they're making a rational calculation, but because it feels safe. And that feeling, that shift from confidence to doubt, is what drives the big moves. Now let's talk about timing, because timing is the thing that breaks most people. You can be right about the direction and still lose money if your timing is off. The problem with timing these moves is that they don't follow a schedule. The bond market can stay stable for months, even years, before it snaps. And when it snaps, it happens fast, faster than most people can react. So the question is not when to get in. The question is whether you're positioned before the move happens. Because once it's obvious, once everyone sees it, the opportunity has already compressed. This is why some people hold metals even when they look expensive. Not because they think the price is cheap, but because they think the risk of being wrong is manageable compared to the risk of being out when the system shifts. Let me bring this back to the bigger picture, because this is not really about gold or silver. It's about what those metals represent. They represent a world where promises are questioned, where paper commitments are weighed against physical reality, where trust, the invisible glue that holds the financial system together, starts to thin. And trust is built slowly and lost quickly. For decades, the system has worked because people believed in it. They believed governments would pay their debts. They believed central banks could manage the economy. They believed the dollar, the euro, the yen would hold their value. But belief is not permanent. It's conditional, and the condition is results. When people see interest payments consuming more of the budget than defense, they start to wonder. When they see deficits that never shrink, they start to question. When they see money being created to buy bonds that nobody else wants, they start to connect the dots. And once those dots are connected, the psychology changes, not all at once, but gradually, like water seeping into a foundation. Gold and silver don't care about narratives. They don't care about speeches or press conferences. They react to the math, and the math right now is uncomfortable. Debt levels are high, deficits are structural, interest costs are rising, and the path of least resistance for governments is to ease the pain through monetary expansion. That's not a conspiracy, it's an incentive structure, and incentive structures are more reliable than promises. So when you see metals climbing, you're not just seeing a commodity rally, you're seeing a repricing, a recalibration of what things are worth when the measuring stick itself is unstable. And the twist, the part that makes this so hard to navigate, is that this process is not smooth, it's jagged. There will be moments where it looks like the rally is over, where prices pull back hard and commentators declare victory for the bears, where people who held through the climb sell in frustration. And then, just when it seems safe to ignore metals again, the next leg starts. This is the cycle. And it repeats until something fundamental changes. So here's where we are. The bond market is showing stress. Central banks are talking about stability, metals are near psychological milestones, and the public, by and large, is still not paying attention, which means we're either at the beginning of something big or we're in another false alarm that will fade into the background. The answer will reveal itself not through predictions, but through observation. Watch the bond market, watch central bank language, watch whether yields stabilize or spiral, watch whether metals consolidate or accelerate. Because in the end, markets don't lie. They might mislead, they might confuse, but eventually they tell you what's real. And if what's real is a system that can't sustain its promises without destroying its currency, then the assets that survive credibility crises will move in ways that shock even the people holding them. The question you have to answer is not whether this will happen. The question is whether you'll be positioned if it does. Because once the door slams, there's no going back for a second look.